Alright guys, welcome. We're just going to do some live streaming during the market. We got Powell speaking in 5 minutes. I definitely want to have that up. Let's see here. Alright guys, welcome. We're just going to do some live streaming during the market. Nice. Yeah, Jay Young, I saw it on the WAP. I just had to take care of some stuff. We're up on the day, almost $1,000 already. We made on TGT 94 per share to 95. Let me just see what we got going on here. Got this, memberships. All right, cool. Yeah, the market right now is like really red. Just like overall, everybody's scared of Papa Powell. I'm trying to figure out where I can get this up, where we can actually listen to him speak. That's really why I wanted to live stream. UNH bouncing off that $300 level that we called out. Let me see. Powell speaking live. Appreciate you upgrading your membership, CD. Appreciate that. Yeah, I'll put the WAP in the channel so people will know what the hell we're even talking about, because we always just say WAP, and I don't think people really understand that we have this whole chat that we have of everybody in it that is able to, you know, it's kind of nice. We have a community of investors that call out plays, so we'll put it out there. Jay Young, you should use your promo code, because then you would get a referral bonus. Oh, let me see if I can find it. There it is. Let's see if this works. See if that works. All right, I'll put that out there for everybody. Yeah, let me see CNBC. Let me just check that. You know, it's only because I'm live streaming. It's different. I'm trying to get it on the actual this. That's why. CNBC. They gotta have it live. It wouldn't make any sense if they didn't. Let me just filter it and see if we get live. Yeah, it's gotta be on the Bloomsburg. I would assume that would cover it too. I'm just looking on YouTube to see if I can find it. But yeah, we had that nice trade, which is beautiful. I love that. It's nice to start the day with some positivity there with almost $1,000. We love that. And now, I mean, we had this nice bounce off UNH, but you got to look at Qs, man. The Qs look weak right now until Powell speaks. This is what we're getting right now. We're getting massive sell-off. And this is okay. I mean, this is healthy. I mean, in the grand scheme of things, I would not be worried. I mean, look at, just put yourself into perspective here. Oh, it won't work? But like, put yourself into perspective. You can see here, I mean, we're trading from highs. It really doesn't look that bad when, you know, you say selling off, but from 583 of highs, you're only down 3%. It's not really a big deal. Unless you've been buying Qs up here at 583, then, you know, bless you. But what I'm noticing is we're seeing a pattern here. I mean, you had this massive rejection of Tesla, 340, now all the way down to 319. That was a level I was watching too, but I'm probably not going to trade today. We're already up $1,000. That is definitely a level that I was watching. And look, I'll just show you so you can see, you can learn from me. It's just simple as looking at this. And look at this bounce you're getting off of Tesla. You have previous consolidations with the push up. You know it's going to be around the 319 to 320 area. That's where you're getting your pop. And now Tesla is responding to this level. I mean, that's kind of an insane sell-off from 338. Just think about it. In the last 5 days, Tesla has sold all the way off. And let's say, you know, you don't want to trade Tesla. It's too expensive, right? I run into that issue. I see that a lot with, you know, in my WAP, whether, you know, people have less money to trade with. You could trade TSLL, which is, you know, look at this. You could buy it for $11, the 2 times bull, but obviously it decays over time, so you got to be careful. But $12 down to 11, basically, right there. So we'll see if we can. Let's see if we can get Daddy Powell up here speaking. I feel like he is going to crush this market, and it would be interesting to watch to see what he would do. So let's see if we can find it. Let's get rid of that. Let's get rid of that. Yeah, you like Burke? Excuse me. Sorry, guys. Let's see here. What do we get? Just trying to find this. I just thought about too. If I could just get him speaking, it wouldn't even matter. As long as we have him speaking, that would be most important. Starting to find some footing here right before he speaks. Yeah, I like those NEs you bought. You're up 5 or 10% right now?
Well over $300 billion. That was under Joe Biden, a corrupt politician.
I don't know. I found some article, but I found a YouTube video, but I'm not sure if this is it. This is showing Trump speaking, not Powell.
But now it's in particular bad. This was done by a corrupt administration that shouldn't have been in, and frankly, if the right results of the election were given, if I were president, this war would have never taken place, and he would have been very happy. Because
yes. Trying to see if we can find Powell. Alright, let's see here. I thought he was 10 a.m. Am I wrong with the time? Hmm. Man, Q's just going down. Yeah, so if you're playing the Qs, you got to be cautious here. Yeah, if you're gonna buy Berkman, I would wait a little bit. Let's just see what happens with this news. Qs though coming down to a support level, which would be nice. Right around here, 560. We'll see when it gets tested here. You're saying BBA rang the bell. I mean, from what I saw, it got torched. It rang the bell. It didn't ring the bell. It's selling off. Calling the National Guard. They need help. Look at this. Oof. Beautiful bounce at that 319. But I'm just wondering if this is one of those days where Tesla's going to $300 today. If this 319 doesn't hold up. I mean, like, looking at this. I'd love to see it come down to 308. I might be a buyer if it comes down to there. I need to see a massive sell-off for me to be buying Tesla. Because it rejected that known 340 level, which was just clear as day right here. This was like a no-brainer. So we'll see. We'll keep the Qs up because that is the most accurate right now. I'm just seeing the overall market. I cannot find the Powell thing. I mean, if you find the link, send it to me, Jae Young, but I cannot find it. But still looking for it. I don't see it. Sometimes you gotta let the market bleed. I mean, it's rejecting the 9 and the 21 EMA. The market is just bleeding right now. And that's what we're doing. That's okay. We're sitting on cash. For me, it doesn't matter. I care less. Yeah, it's incredible watching this. So anyways, you're looking at this. I added to ETH. I added to XRP today too, just so you know. I'm just throwing it out here because we're here in this link. But I bought XRP around 285, just adding to it to my long-term position. I do think it has more downside coming down to 270, but I decided to buy some. Oh, sweet. There you go. Let me see here. Oh, there you go. So you found it. Okay, thank you. Let me click on this thing and see what we can do.
Imagine being able to build an app with your name on it. Just
Oh, it's using the Associated Press. I see. Okay. There we go. So when he comes on, we'll thank you for finding that, Jay Young. When we comes on, we'll put this on. Oh, he is speaking. Oh crap! I didn't notice. Sorry about that. There we go. This is live. It's like they all clap for him because they know he's going to crush the market.
This year's conference is a key element of the Federal Reserve's ongoing review of its monetary. With that, let me get us started.
Let's let the man come up and crush the market.
Thank you, Trevor, and good morning. I'd like to add my welcome to everyone. Thanks for being here. Thomas Laubach's research and his broader support of the FOMC helped us better understand monetary policy, and it is fitting that this work will continue today in his name. Thank you to the authors of the papers, to the discussants, and to our panel participants, and thank you also to Trevor and his team for organizing this conference. A whole lot of work went into bringing us together. As in our last review, the 2025 review consists of three key elements: this conference, Fed Listens events at the reserve banks around the country, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In the current review, we will reconsider aspects of our strategic framework in light of the experience of the last 5 years. We will also consider possible enhancements to the committee's policy communication tools regarding forecasts, uncertainty, and risks. In 2012, the FOMC first codified our monetary policy framework in a document entitled The Statement on Longer-Run Goals and Monetary Policy Strategy, which we refer to as the Consensus Statement. The language in the opening paragraph, which has never changed, articulates our commitment to fulfilling our congressional mandate and to explaining clearly what we're doing and why. That clarity reduces uncertainty, improves the effectiveness of our policy, and enhances transparency and accountability. As chair, Ben Bernanke led the committee through the creation of that initial consensus statement, adopting a 2% inflation target and outlining our approach to achieving our congressionally assigned dual mandate. The framework laid out in that document broadly aligned with best practices for a flexible inflation targeting central bank. The structure of the economy evolves over time, and monetary policymakers' strategies, tools, and communications need to evolve with it. The challenges presented by the Great Depression differ from those of the Great Inflation and the Great Moderation, which in turn differ from the ones we face today. A framework should be robust to a broad range of conditions, but also needs to be updated periodically as the economy and our understanding of it evolve. From 2012 to 2018, the FOMC voted at each January meeting to reaffirm the consensus statement, in most years without substantive changes. In 2019, we changed that practice, conducting our first ever public review, and said that we would repeat such reviews at roughly a 5-year interval. There's nothing magic about a 5-year pace. We believe that frequency is appropriate to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. Several of our global peers have adopted similar approaches to their framework reviews. At the time of the last review, we had been living for about a decade in a new normal characterized by proximity to the effective lower bound, with low interest rates, low growth, low inflation, and a very flat Phillips curve. If I could capture that era with one statistic, it would be that the policy rate had been stuck at the lower bound for 7 long years following the onset of the global financial crisis in late 2008. After liftoff in December 2015, we were able to raise the policy rate only very gradually over a period of 3 years to a peak of just 2.4%. 7 months later, we began reducing it, leaving the rate at 1.6% in late 2019, where it would be when the pandemic arrived a few months later. Policy rates in other major advanced economies were even lower, in many cases below zero, and in all such economies, inflation regularly ran below its target. The sense at that time was that when the economy next experienced even a mild downturn, we would be right back at the lower bound, probably for another extended period. The post-financial crisis decade had demonstrated the pain that that could bring. Inflation would likely decline in a weak economy, raising real interest rates as nominal rates are pinned at zero. Higher real rates would further weigh on job growth and reinforce downward pressure on inflation and inflation expectations. Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target, an approach that was common in the extensive literature on the risks associated with the lower bound. Given the downside risks to employment and inflation from proximity to the lower bound, and the need to anchor longer-term inflation expectations at 2%, we said that following periods in which inflation has been running persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time. We also concluded that policy decisions would be informed by assessments of shortfalls rather than deviations from maximum employment. The change to shortfalls was not a commitment to permanently forswear preemption or to ignore labor market tightness. Rather, it signaled that apparent labor market tightness would not, in isolation, be enough to trigger a policy response, unless the committee believed that, if left unchecked, it would lead to unwelcome inflationary pressure. This change reflected our experience with long expansions that featured historically low unemployment amid low and stable inflation, suggesting that a policy approach that carefully probed for the maximum level of employment could bring about the benefits of a strong labor market without risking price stability. In the years just prior to the pandemic, for example, unemployment was at multi-decade lows while inflation ran below 2%. By December 2019, estimates of the longer-run unemployment rate had fallen sharply. The use of shortfalls acknowledged that a combination of low inflation and low unemployment does not necessarily pose an adverse trade-off for monetary policy. The economic conditions that brought us close to the lower bound and drove the changes in our consensus statement were thought to be rooted in slow-moving global factors that were likely to persist for an extended period, at least until our next 5-year review. And that might well have been the case had the pandemic not intervened. The idea of an intentional moderate overshoot proved irrelevant to our policy discussions and has remained so through today. There was nothing intentional or moderate about the global inflation that arrived a few months after we announced our changes to the consensus statement, and I acknowledged as much publicly in December 2021. We fell back on the rest of the framework, which called for traditional inflation targeting. Through the end of 2021, FOMC participants continued to forecast that inflation was likely to subside fairly quickly in 2022, with only a moderate increase in our policy rate. That projection was consistent with other central banks with different frameworks and the vast majority of forecasters. When the evidence showed otherwise, we hiked 525 basis points over a period of 16 months. The most recent data suggests that 12-month PCE inflation was 2.2% in April, far below its 7.2% peak in 2022. And in a welcome and historically unusual result, as this room knows, this disinflation has come without the sharp increase in unemployment that has often accompanied a campaign of rate hikes to reduce inflation. The economic environment has changed significantly since 2020, and our review will reflect our assessment of those changes. Longer-term interest rates are a good deal higher now, driven largely by real rates, given the stability of longer-term inflation expectations. Many estimates of the longer-run level of the policy rate have risen, including those in the Summary of Economic Projections. Higher real rates may also reflect the possibility that inflation could be more volatile going forward than during the inter-crisis period of the 2010s. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. While our policy rate is currently well above the lower bound, in recent decades we have cut the rate by about 500 basis points when the economy is in recession. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continue to address that risk. While the framework must evolve, some elements of it are timeless. Policymakers emerged from the Great Inflation with a clear understanding that it was essential to anchor inflation expectations at an appropriately low level. During the Great Moderation, well-anchored inflation expectations allowed us to provide policy support to employment without risking destabilizing inflation. Since the Great Inflation, the U.S. economy has had 3 of its 4 longest expansions on record, Anchored expectations played a key role in facilitating these expansions. More recently, without that anchor, it would not have been possible to achieve a roughly 5 percentage point disinflation without a spike in unemployment. Keeping longer-run inflation expectations anchored was a driving force behind establishing the 2% target in the 2012 framework. Maintaining that anchor was a major consideration behind the changes in 2020. Anchored expectations are critical to everything we do, and we remain fully committed to the 2% target today. In the current review, the committee is engaged in discussions about what we have learned from the experience of the past 5 years. We plan to complete consideration of specific changes to the consensus statement in coming months. We're paying particular attention to the 2020 changes as we consider discrete but important updates reflecting what we have learned about the economy and the way those changes were interpreted by the public. In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation target. We will ensure that our new consensus statement is robust to a wide range of economic environments and developments. In addition to revising the consensus statement, we will also consider potential enhancements to our formal policy communications, particularly regarding the role of forecasts and uncertainty. As we have been reviewing assessments of the 2020 framework and of policy decisions in recent years, a common observation is the need for clear communications as complex events unfold. While academics and market participants generally have viewed the FOMC communications as effective, there is always room for improvement. Indeed, clear communication is an issue even in relatively placid times. A critical question is how to foster a broader understanding of the uncertainty that the economy generally faces. In periods with larger, more frequent, or more disparate shocks, effective communication requires that we convey the uncertainty that surrounds our understanding of the economy and the outlook. We will examine ways to improve along that dimension as we move forward. So let me end by saying thank you again for being here. We've been looking forward to this. All of us have been looking forward to being with you today and having these conversations that will occur over the next 2 days. These discussions will help broaden and deepen our thinking about these issues, and they're critical to the success of these reviews. Thank you very much.
Look at PLTR, baby. We called this out at 185. Wow. Finally going back to earth. But everything is selling off. Might just be a red day. Should have held my target position. God damn. Need Daddy Powell to come in and stop the bleeding. Let's see if we can break through this 9 EMA. Yeah, it's starting to come up here. We'll see, testing this 9 EMA right here. It's gotta give it time to play out. Guys, this is incredible watching this. Tesla is just making lows. Let's just get rid of this support level because that's gone. I want to see 308 on this. 308 on Tesla would be beautiful. I don't know if we'll get it though. Manning, he's back, baby. Tesla really showing potential here at this 316 level. I should say 318. I didn't realize it bounced so high already. Let me see if we got Matt, you make any trades? Yeah, what time is he speaking though? That's the thing. I thought it was 10 a.m. The stream said 3 months ago. That's what I was wondering. It said 3 months ago on it, and I was like, is this him actually speaking? So I'm not sure if we had the right one, Jan. Yeah, I'm not sure. I mean, I thought he was supposed to speak. Let me see if I can find it on X. Yeah, let's try that. I see the link you sent. It's becoming like the news investor channel over here. Now we're gonna have the I guess we even got tunes for this. We'll leave this up here in case, but still don't really see much. So this is a classic. We'll leave in the background for now. This is a classic case of we just gotta be patient here. You gotta watch the stocks, watch them sell off, watch it die. Is he? Look at Tesla making new lows. See, I think what you sent us was the July 22nd, 2025 open remarks. I mean, it looks similar to the video you sent. I'm trying to see if we have anything brand new. Maybe it's just on NBC, you know? It's not live. Man, Tesla going down, baby. It's crazy. In 5 days. This is why Tesla's so scary to trade. I mean, look at this. If you guys, anybody bought here at 340, down 7% in 1 day, 2 days. It's crazy. It's crazy stuff. Anyways, let's go on the WAP. What are you guys trading over here? Anything good? Hims has the worst spread. Let me see. Oh, $41. Wow, the market's really red today. This is like, look at PLTR, 10% almost today. Wow. So this will be our short level now. So for PLTR, if you can get a move like this, if we get any bounce here, bounce up here, and then push down. Wild. I'm gonna make some ads. Let's see what I got. Let's see what I got over here. Yeah, Tesla and PLTR are just completely dying. It's like scary to watch. Does Tesla even have news that, or is this all just cautious buy? It's saying the Tesla CEO says Model Y variant might not start production. Very interesting. Oof. Wild. Tesla 5-day 5-minute less than 25 right now. It's very tempting, but it's not above this 9 EMA, so it makes it kind of scary. I feel like it's hard to see if there really is support here. I mean, you can move this up a little bit. Let's take a look. Yeah, maybe. I mean, it's not very, like, strong, though. You know, looking through this here, maybe. It's a steep drop. I think I like would need to see like maybe 310, 311. And this would be like a hold. Jay, it's just us in here, man. It's me, you, and Manning in this. You guys know what 9 EMA is. But I appreciate what you're doing. So, did you hear Powell speak? Because like I didn't. Did he say anything? You know. That would just be interesting if you could do that, right? I don't know. Can he? I have no idea. Yeah, I don't think he can, man. Tesla's starting to turn here. That was the buy, I think. 314, 315. We'll see. It's trying to get above this 9 EMA right here. Look at the 5-minute on it. It's still above. It's got to get above the 318 to really start to think about it. But I'm not against anybody trying to take a stab here and just keeping your stop low a day. Yeah, he would have definitely got rid of him, I think, if he could have. Unless that's the art of the deal. Yeah, I think this is the reversal, boys. Staring right at it. Tesla's bouncing. XRP is bouncing. HIMS is dead. RGTI 14. This thing doesn't even make any money. Can't believe it's still 14 bucks. This should eventually go back to 5 bucks. Ooh. Look at that, baby. Getting smoked. All these AI stocks starting to finally come back to earth. That's what's happening. Now it's trading below this $17 range. We might be headed down to here. $14, $15. Alright guys, I gotta take care of some stuff. I'm gonna end the live stream. I appreciate you guys tuning in. Manning, thank you. Jay Young, thank you so much. For those of you that are on listening, I appreciate you guys. We added some XRP today. We added some UNH at 297. Just long-term investments. Nothing crazy. A couple $100 here and there. And we're gonna go from there. Guys, message me on the WhatsApp.